If you are sitting in the same portfolio today that you were sitting in 2 years ago, and you are telling yourself that time will take care of the risk, I want to speak to you very plainly. That sentence used to be much safer than it is now. For most of my life, I have believed in patience, discipline, and the enormous advantage that comes from owning productive assets over long periods of time. I still believe that. I will believe it until they carry me out, but there is a difference between believing in long-term investing and sleepwalking through a regime change. A great many people confuse those two things. They think prudence means doing nothing. They think patience means refusing to adjust. They think diversification means holding a little of everything, even when the rules that supported those prices have already changed. That is not prudence. That is nostalgia dressed up as wisdom. What made the last 15 years feel easy was not that markets had suddenly become rational, or that risk had disappeared, or that every investor had become a genius. What made it feel easy was that money was almost free after the financial crisis. And then again, with even greater force during the pandemic years, the American financial system was flooded with cheap money. Interest rates were pushed down to levels that would have looked absurd in an earlier era. Trillions were created, bonds were bought, liquidity was sprayed everywhere. When money costs almost nothing, almost every asset can look smart for a while. Stocks go up, bonds go up, real estate goes up, private investments go up, speculation goes up. Even bad decisions can look brilliant when the current is carrying every boat downstream. That is the world many people still think they are living in. They are not. I want you to imagine a family that built its entire house beside a river, when the water was calm and generous. The land looked fertile, the view was beautiful, everything about the decision looked intelligent. Then the river changed course. The family kept admiring the old blueprint. That is where many retirement portfolios are right now. They were built for a world of zero rates, expanding multiples, reliable bond ballast, mild inflation, and a central bank that could rush in with cheap money whenever something cracked. That blueprint worked. I understand why people trusted it. It did work. But if the river changes course, your respect for the old blueprint will not keep your house dry. The reason I am speaking with urgency is not because I enjoy dramatic forecasts. I have never had much interest in theater. I like arithmetic. I like incentives. I like looking at the actual structure underneath what people call prosperity. And the structure under the American market right now is not healthy. The United States has accumulated an amount of federal debt so large that the interest cost alone has become a major line item in the national story. More than $35 trillion of debt sits on the table, and the annual interest expense has pushed above $1 trillion. That is not a side issue anymore. That is the issue sitting in the middle of the table. Eating first, you can hide many sins when money costs nothing. You cannot hide them when refinancing begins to happen at materially higher rates. For years, the country borrowed in a world where capital was cheap and people assumed it would stay cheap. That assumption is now being tested at exactly the same time that the population is aging. Entitlement promises are swelling, and Washington still behaves as though arithmetic is an optional branch of political philosophy. I have watched governments for a very long time. They do not voluntarily choose pain when they can postpone it. They delay, they rename the problem, they move it around, they let inflation do the dirty work that honesty would have done up front. That is one reason I think so many ordinary savers are underestimating what comes next. They think the danger is a headline. I think the danger is the mechanism. They are waiting for a dramatic moment. I am looking at the mathematics that make dramatic moments more likely. On top of the debt problem, you have a second force that matters enormously. The economy is now trying to operate with meaningfully higher interest rates than it enjoyed for most of the post-2008 period. That is not just an inconvenience for stock valuations. It reaches into every corner of the system. Commercial real estate must refinance, regional banks carry loans that were made in a different rate world. Consumers who already stretched themselves when money was cheap are now facing a harder budget reality. And corporations that looked wonderfully efficient when the cost of capital was microscopic are learning that leverage is less charming when the bill arrives every quarter. Then you layer in tariffs, supply chain friction, and the lingering possibility that inflation will not behave nicely just because policymakers would prefer it to. This is the combination I do not like. It is not one thing. It is expensive money, heavy debt, sticky inflation risk, and an economy that has grown emotionally dependent on rescue. When you get that combination, you do not need a depression to create pain. You only need the market to reprice the fantasy. And that repricing can be severe. What worries me most is not the young investor with a long runway, a paycheck coming in, and the ability to continue buying through weakness. What worries me most is the person near retirement, or already in retirement, who still thinks a large decline is merely an emotional inconvenience. For a young investor, a bear market is unpleasant. For a retired investor drawing from savings, a bear market can permanently alter the standard of living they are able to maintain. That distinction matters more than almost anything else. When you are 35, a large market decline can be survived with time, continued contributions, and an ability to buy more at lower prices. Time is still working on your side in a muscular way. When you are 65 and withdrawing from the portfolio to pay for groceries, insurance, medication, repairs, and all the ordinary things of life, a large decline does not simply hurt your feelings. It changes the math. You are forced to sell assets in a damaged market to fund your life. Those shares are gone. The recovery, if it comes on a smaller base. That is how two people can experience the same market and suffer entirely different consequences. One of the great mistakes in finance is speaking to retired people with the same tone you use for accumulators. The principles overlap, but the consequences do not. I have always believed that if a thing is irreplaceable, you should treat it differently. Capital near retirement is irreplaceable in a way that capital at 30 is not. You can earn more money at 30, you cannot earn more youth at 68. So when I think about what I would want in front of me if I believed the next few years were likely to punish complacency, I do not start by asking where I can get the biggest thrill. I start by asking what survives, and then I ask what can quietly grow while survival is being tested. That leads me to three places, not because they are fashionable, not because they are magical, but because they do very specific jobs in an environment where old assumptions are being dismantled. The first is gold. I know some people roll their eyes the moment gold enters the conversation. They imagine a salesman in a loud suit, a television commercial playing to frighten retirees, and some melodramatic promise that civilization ends next Tuesday unless they buy coins before dinner. That is not how I think about gold at all. I do not think of gold as a costume for fear. I think of it as a hedge against human behavior that repeats over and over again whenever governments become too indebted, too politically weak, or too unwilling to admit that the currency has become the release valve. Most people describe gold as an inflation hedge. That is not wrong, but it is incomplete. Gold is not just a hedge against higher prices. It is a hedge against a government choosing the path of currency dilution because the honest path is too politically painful. That distinction matters. If a government owes more than it can comfortably finance, it has only a few broad ways out. It can cut spending aggressively. It can raise taxes aggressively. It can default openly, or it can allow the value of the currency to erode over time, reducing the real burden of nominal obligations. History tells you which answer politicians prefer. They prefer the answer that lets them deny what they are doing while still doing it. They will not stand up and say, "We are now degrading the purchasing power of your savings because we lack the courage for a cleaner solution." They do it through deficits, accommodation, financial engineering, and enough inflation to quietly transfer wealth from disciplined savers to indebted systems. Gold exists outside that promise. It does not depend on the good manners of a central banker. It does not require an earnings multiple. It does not ask a politician for permission to remain scarce. That is why central banks themselves have been buying it so aggressively in recent years. They are not doing that because they became romantic. They are doing it because they can read a balance sheet and understand geopolitics. When countries around the world gradually reduce their dependence on dollar assets and increase their gold holdings, they are sending you a message in the most serious language the financial world has. They are saying that trust is being reallocated. That does not mean gold must go straight up every month. It never works that neatly. It does mean that in a world of fiscal strain, currency debasement risk, and policy improvisation, I want some part of my wealth anchored in something that cannot be printed and cannot be diluted by committee. Now, I would never tell you to put every dollar into gold. That would be as foolish as pretending gold has no volatility, no cycles, and no moments when it can badly disappoint impatient owners. Gold is not a business. It does not build railroads or sell candy bars or compound retained earnings through managerial brilliance. It is not that kind of asset. But as a piece of protection, it has a role that becomes more valuable when the guardians of paper money start behaving as though arithmetic is negotiable. The way you own it depends on your circumstances. Some people prefer physical metal. I understand that instinct. There is a certain finality to actually owning the thing with no counterparty between you and the asset. Other people prefer an ETF that tracks the gold price because it is simple, liquid, and practical inside a brokerage account. A few choose miners because they want operating leverage to the metal and are willing to accept the additional business risk that comes with that route. I have no interest in turning a sensible allocation into a religion. What matters is understanding the job. Gold is there because if the fiscal path continues to deteriorate and the dollar's purchasing power becomes a policy casualty, I want part of my capital standing somewhere solid. The second place I want to be careful about is the bond portion of the portfolio. This is where a tremendous number of decent, diligent people are being misled by old language that no longer fits the moment. For decades, people were told that bonds are the safe part. As you get older, move more money into bonds, reduce volatility, sleep better. That advice worked beautifully in an era when rates had a structural tendency to fall and bond prices could rise right along with the comforting story. But the sentence bonds are safe is incomplete to the point of being dangerous. What kind of bond at what duration, in what inflation regime, against what debt backdrop, under what policy pressure? These questions are not academic. They are the whole game. If you hold a long-duration bond in a world where inflation is reaccelerating or rates need to stay higher for longer, you are not holding a safe instrument just because someone printed the word Treasury on the label. You are holding an asset with enormous sensitivity to rate changes. That sensitivity is not theoretical. A long bond can lose a shocking amount of value when yields rise. The investor who thinks I am being conservative may discover they are actually sitting on a concealed speculation about the future path of inflation and policy. That is not conservatism. That is confusion with a coupon attached. I would much rather own short-duration government paper in this environment. Treasury bills do not excite the ego. Nobody brags at dinner about a 3-month bill. But I have learned that dull can be a beautiful quality when the world gets noisy. A short bill gives you yield without making a giant bet on the direction of long-term rates. If rates move higher, you roll the maturing instrument into a new one at the higher yield. You do not sit there trapped inside a long-duration structure watching the market value of your supposed safety shrink. That matters enormously. Short-duration paper is not there to make you rich. It is there to protect capital, preserve optionality, and pay you a fair return while uncertainty clears. That is honest work for capital. There is another corner of the fixed income world that deserves attention too, and that is inflation-protected securities. If inflation remains more stubborn than the official optimists would like, instruments whose principal adjusts with inflation are far more sensible than pretending a nominal long bond is a sanctuary. Again, this is not glamorous. A lot of good investing is glorified boredom with discipline wrapped around it. People get hurt because they want a fortress to feel exciting. A fortress is supposed to be sturdy, not thrilling. If I were helping someone near retirement think about their defensive money, I would be far more interested in short-term government instruments and inflation-linked protection than in reaching for long nominal bonds, simply because the old rulebook said bonds calm the portfolio. Rules that ignore the interest rate regime are not rules. They are relics. The third place I would want meaningful exposure is in businesses with genuine pricing power, especially in sectors people cannot easily avoid. This is the part that gives a portfolio some ability to grow while still respecting the danger of the environment. When inflation rises or input costs become more unstable, the distinction between a good business and a fragile one becomes brutally clear. A fragile business is forced to absorb higher costs and hope for mercy. A strong business passes those costs along and keeps going. That ability to raise prices without destroying demand is one of the most valuable characteristics a company can have. I have spent my life looking for businesses that possess some version of that trait. A strong brand, a needed service, a habit embedded in daily life, a product for which the customer does not hold an easy substitute when the world becomes more inflationary, more indebted, and more politically clumsy. Pricing power is not a luxury. It is armor. That is why I care so much about healthcare, energy, and consumer staples. In an environment like this, healthcare is not discretionary. In any meaningful sense, a great many medical needs do not politely wait for macro conditions to improve. The demographic wave moving through America is real. The largest generation in the country's history is aging. Demand for care, treatment, devices, and essential medicines is not going away because the stock market has a bad quarter. That kind of demand gives the right businesses resilience. It does not make them perfect. It does make them sturdier than the crowd expects during broad market trouble. Energy matters for a different reason. When supply chains are strained, geopolitics is unstable, tariffs are distorting flows, and the cost of moving the modern world is under pressure. Domestic energy producers sit in a place of unusual importance. Their product is globally relevant. Their economics can improve quickly when prices rise. And unlike fashionable narratives built on promises of tomorrow, these businesses often produce real cash today. Consumer staples may be the least exciting category in the entire market. I am fond of that. People may postpone a vacation, they may delay a home upgrade, they may trade down in many categories, but they do not stop eating. They do not stop washing clothes. They do not stop buying the ordinary products that keep a household functioning. A business that sits inside those routines with strong distribution, trusted brands, and the ability to nudge prices without losing the customer is a wonderful thing to own when speculative glamour starts to crack. What I would avoid, or at least cut down severely, are the parts of the market still priced as though we have returned to the old paradise of free money. That means businesses whose valuation depends overwhelmingly on a distant future. That means companies whose multiples only made sense when rates were pinned near zero and the market was willing to pay almost anything for growth stories, no matter how thin the actual present earnings happen to be. I am not hostile to technology. I am hostile to overpaying. A wonderful business purchased at a foolish price can still produce a foolish result for the owner. When the discount rate changes, dreams get repriced. And in a higher rate world, the businesses furthest out on the duration curve of imagination are often the ones that suffer the hardest. This is not because innovation dies. It is because price matters. It always mattered. Cheap money merely trained people to pretend it did not. There is another dimension here that I think deserves blunt speech. Many people feel emotionally safer owning the broad market because the broad market sounds neutral. But if the broad market is heavily influenced by the largest, most expensive growth names, you may be carrying far more sensitivity to a rate and valuation reset than you realize. Sometimes what looks like balance is merely concentration wearing an index costume. That is why I prefer to ask a more practical question. If the next 5 years involve stickier inflation, heavier debt burdens, more policy improvisation, and a lower appetite for fantasy multiples, what do I want to be paid to own? I want to be paid to own things people need. I want to be paid by businesses that can protect their margins. I want to be paid by companies that do not require the return of zero rates to justify their existence. I want to be paid while I wait. That is what real pricing power combined with sensible valuations can offer. Now, let me step back and make the deeper point, because I do not want this to sound like a shopping list. This is not really about gold versus bonds versus stocks. It is about understanding that the environment changed and the portfolio must reflect that. When the tide goes out, you discover who was swimming without a suit. Everyone knows I have said that for many years. What people forget is that the tide does not only expose speculators, it exposes lazy assumptions. It exposes the retiree who thought long bonds were automatically safe because a chart from another era said so. It exposes the saver who believed diversification meant never questioning the shape of the basket. It exposes the investor who treated a decade of unusual monetary policy as permanent climate instead of temporary weather. If I were sitting across the table from someone who had worked for 40 years, saved responsibly, and now wanted to protect what cannot easily be rebuilt, I would not try to impress them with complexity. I would say this: do not build your retirement on the assumption that the old rescue mechanisms will work the same way and at the same speed they used to. Do not assume that because a portfolio survived one regime, it will thrive in the next. Do not mistake familiarity for safety, and do not wait for television to make the case obvious, because obvious is usually the most expensive time to act. By the time everybody agrees something changed, the repricing has already done most of its work. That does not mean panic. Panic is wasteful. Panic causes people to sell what they should keep and keep what they should question. What I am advocating is not panic. It is deliberate repositioning. A little less faith in the old playbook. A little more respect for duration risk. a meaningful place for gold as protection against fiscal and currency decay, a serious preference for short-duration government paper and inflation, linked instruments over long bonds that can be badly injured by the wrong rate path, and a meaningful commitment to businesses with pricing power in essential sectors rather than overgrown dreams priced for a fantasy that may not return. That is not surrender. That is adaptation. There is also a moral dimension to all this that matters to me. People near retirement are often told to keep trusting the system because patience has always been rewarded. That line is sometimes used honestly. It is also sometimes used by people who do not bear the consequences if the retiree suffers a permanent impairment of capital at exactly the wrong time. A hedge fund manager who takes a large drawdown can regroup. A retiree who sells depressed assets to fund living expenses may never truly recover. That is why protecting the downside matters more as you age. It is not pessimism, it is respect for sequence and time. I have always admired optimism that can survive arithmetic. What I do not admire is optimism that ignores arithmetic and then asks disciplined people to pay for the difference. The country's debt arithmetic is ugly. The policy options are limited. The inflation path is uncertain. And the market still contains pockets priced as though the old world is returning on schedule. I do not know the exact day the market decides to care about all of this with full seriousness. I do know that by the time the crowd feels certain, the easy defensive moves will already be behind you. You do not need to predict the storm with perfect precision to close the windows. You only need to notice that the sky looks different and that the weather report is no longer written for the world you remember. That is where I think we are now. So here is the test I would leave you with. If you looked at your portfolio honestly, not nostalgically honestly, and asked whether it is built for the world of the next 5 years rather than the world of the last 15, what would the answer be? If rates stay higher than people hope, does it still make sense? If inflation proves harder to tame, does it still make sense? If the government tries to ease the debt burden through slow currency debasement rather than open honesty, does it still make sense if the market stops paying extravagant prices for distant promises? Does it still make sense if you cannot answer yes with a straight face? Then what you need is not reassurance. What you need is a plan that protects the irreplaceable, a plan that accepts the new arithmetic, a plan that favors sturdiness over fashion, cash flow over fantasy, and optionality over ego. I would rather look a little too careful at the beginning of a hard period than a little too brave at the end of one. That is how people keep what matters. And when you keep what matters, you give yourself the ability to buy well later when others are forced to repair what they should have defended. That in the end is the whole game. Not being the smartest man in the room, not making the most dramatic prediction, not impressing strangers with complicated language, just protecting your capital when protection is needed. Owning strength when weakness is overvalued, and staying rational while a crowd argues with reality. That is how you reach the other side with your freedom intact. That is how you keep retirement from becoming a decade of recovery. That is how you make sure the money you spent your whole life building is still there to serve, the life it was meant to serve. And if I were moving money before a hard 2026, that is exactly how I would think about it.